I'm just going to play a video. We have a minute or two left.
Okay.
Okay, everyone, we're just waiting for more people to come in. Also, just want to share it on Facebook.
Giancarlo joined.
Okay, people are coming in. People are coming in. Okay. Okay, I see people are coming in. Welcome, welcome. So as more people are coming in, before I give it over to Istvan and John Gaspar, I just want to make sure that my side that we're live on Facebook and we're getting ready for the screen share. Let me quickly tell you guys what today is going to be about. So today we're going to learn about investing during chaos, part 1. What is really happening in the world? This is by Gaspar Andres and Istvan Takic. Just want to put my camera. We're going to focus on, these two guys are international. They're all from Hungary, and Gaspar, I think, is a Catalan from Spain, and they're going to, both of them are retired from their corporate jobs. And Gaspar is investing full-time. This is actually full-time, his job. Actually millions, wow. Istvan is trading, and we are constantly searching for the right information to understand what is really going on in the markets. These two sessions that has been designed to give you the essence of what we see happening in this COVID-19 pandemic caused in the economy, how the financial markets got big time distorted, and we also give you some suggestions and tips how we think you should approach the topic of investment in this new era. The decade ahead of us will be full of challenges and opportunities. So we would like to help you to get started with investing and basically fall in love with investing, as we are facing a once-in-a-generation opportunity to get into wealth. And I totally agree. We hope and meet like-minded people, share your knowledge, and if you want to keep in touch with us and discuss and help ongoing research, we want to hear from you. So these guys took out their time today to be able to share with you. They're very experts in their field, and I want to say thank you to you guys for being here this morning. Is Gaspar still there?
I think we lost.
I see we lost Gaspar. So we're just going to wait for Gaspar to rejoin, everyone. And will you just find out from his side about the loss? So in the comments box, so start commenting where you're from, what you are learning. I want to learn about investment that hopefully we will answer during this talk. We're just waiting for Gaspar to rejoin the talk. Just want to find out if he saw. Okay, thank you. So let's say, Sonia, thank you for your time. Sonia, yeah, I totally agree. They're giving their time. They're very exceptional people, and they've made a lot of money on the stock exchange. And I would love them to share with you. And I think that is why they're here today. There's not going to be any selling. This is just going to be giving a value and for you to learn from experts in their field. Giancarlo, nice to see you again. Why Gasper so serious? Smile. Well, Gasper, that's probably why he left. Sonia from Durban. Yeah, Sonia. I hear you. But does he? Iswan, is our friend getting right?
Yeah, I'm just contacting him on WhatsApp, so his screen froze and he tries to log in.
Okay. So restarting again. Okay.
Actually, I think maybe I just say a couple of words. So, so Gaspar is really a serious investor, and he's the analytical mind. So he tries to understand what's going on in the market. And since this COVID-19 crisis started, we were in constant discussion about what is going on, what is the best way to to invest your money, and what is happening, and then. Out of that board this presentation, which Gaspar did a couple of times. He also did it together 2 or 3 times. And now he's back. And I mean, we are not doing it for money. We are not pitching anything. We are just trying to share with you what we see, what is happening. This is the first part. And then next week, we will have another session where we are going to focus on, given the circumstances, what is going on in the world, what do we suggest you to invest in? I mean, it's not an investment advice, it's more a kind of giving you a direction to think. And at the end of the presentation, we will share our email, WhatsApp, and if you have any questions afterwards, we are more than willing to discuss with you offline. And now I see that Gaspar
yes. So, yes. Thank you, Istvan. Can you hear me?
Yes.
Okay. Yes, we can hear you. Welcome back, Gaspar. The floor is yours.
Thank you very much. Okay, thank you, Istvan, for the introduction. I didn't catch it from the beginning, but yes, Istvan and I are ex-corporate executive from a multinational. And I personally started investing many years ago, and that allowed me to early retire and have quite some money to play with. And the idea would be try to help you guys do the same in this very special moment that we are at right now. And I put this a slide about debt. If you are in the phone, please switch to the presentation because we'll use the graphics a lot. So I put this because we're going to talk a lot about debt. And this sentence is a little bit pessimistic, but it's maybe more realistic. It's about debt is about solving the problems of today by robbing from your own future. So that's the tone of the discussion is about debt. And here's a little bit the agenda for today. As Istvan said, we're going to cover first in this session what's happening. And it's relevant to cover rather than start telling you guys what you need to invest on, because we are in a very special situation where the stocks, picking the right stocks doesn't matter anymore. As an example, when the crash of the COVID came, no matter which stocks you had, they went all to hell. So it's more important to understand what's happening in the economy that talk about different companies, because the fundamentals don't matter that much in a situation like now. You will see more about that. So we'll talk about how big is this crisis, what are the central banks doing, and what's wrong with it? What's wrong with the way we are dealing with this crisis, and what can you do about it? Okay, and you will see it all makes sense. And then next week, Istvan and I are going to present the second part, which is more practicalities about how to invest in a way that you don't need to spend 8 hours a day thinking about it, but more like low maintenance investment, which is what I did while I was working. And let me start with this slide. This is talking about financial crisis. They are complex, but at the same time they are very simple. It's always about bubbles, right? Debt bubbles. So that makes it a little bit simple. And in this specific chart, we have the corporate debt, so the debt of the companies in the US. And you can see that it's like a multi-generation waves of debt that lasts approximately 10 years each. It goes on, companies are taking a lot of debt, and then they deleverage a little bit, and they go up again, and so on. But what is interesting is that when they go back, they never go back to the beginning, but they keep some accumulated debt that they don't get rid, and it goes up and up and up. So all this multi-generation brings us to where we are right now in 2020, where it says everything bubble, means that there is a debt bubble in many areas. Like in 2008, for example, was a housing bubble. Now it's everywhere, the bubble. And it's we are probably getting close to the end of this long-term cycle with many mini cycles of 10 years. And in order to think a little bit about how big is this problem or how big is this crisis, I put together not just the corporate debt, but a few more data that we will go through now, right? So just to dimensionalize how big is that thing. So this next slide talks about the government debt. In that case, it's not the corporate debt, but the government debt. And by the way, we're going to talk a lot about USA. If we go and take a look at Europe or some other economies, UK and so on, it's a copy paste, right? So bear with us. We are talking a lot about US, but it's the same for many other countries, including South Africa. And okay, anyhow, back to the slide. You see here on the left the corporate debt in a very long time. It's from 1900. And you see that the debt typically has going up basically for two reasons in this chart. For the two world wars that we had, World War I and World War II, of course, US had to take debt to just finance the war. And then the Great Depression in 1930 or 1929, which was the biggest so far. And now, after 2008, you see the red circle there. In 2008, we had 38% debt as a percentage of the GDP, and now we are at about 120 and going up like a rocket, as you see there. We are going to talk a little bit why is this happening. The same on the right-hand side. Here's a zoom in into closer time, and you can see the same effect that in 2008 we crossed the line and the debt start growing faster than the GDP. This is very dangerous. And at the end in 2020, right now is going almost vertical. The problem of that is that, like in a family, right? So if you are in a family and you take debt, when the debt gets bigger and bigger, you may reach a point where you mathematically cannot give it back, right? So you pay so much interest that you cannot return the debt. It's mathematically impossible. And I'm arguing that we are getting close to this point right now. The next slide is switching gears from debt to unemployment, right? So maybe, when we think about COVID-19, most of the issues with this crisis, we'll see that we're independent of the COVID-19. So we could say that the COVID-19 have burst the bubble, but the bubble was already there. As you have seen in the debt was before the COVID-19 was already there. And many other things that we'll see were there anyhow. So COVID did not create this problem, it burst it. Except maybe unemployment. Unemployment is the one that is really, really COVID related, at least the starting point of it. And you can see first on the right that the level of unemployment in US, it reached 30 million people, is a record high. And also because of the speed of how it went up. And then on the left, you see not the unemployment, but the employment, right? So how many people are employed in US over time? And you can see there, the drops are the crisis where the employment goes down. And you can see, for example, in 2002, we dropped 2 million people from the employment, and it took 4 years to recover. In 2008, we dropped 9 million people and took 6.5 years to recover. And now we are dropping 30 million people. So if you just put it in perspective, this is a huge crisis. Of course, when the virus goes away, we will recover a portion of that. But thinking about recovering super fast, it's not going to happen. Now, let me switch, still in the mood of showing how big is this crisis. I want to talk about the stock bubble, the stock market bubble. And again, the crisis was there before. This chart on the left shows is the SP 500, so reflects the Wall Street in US, the 500 biggest companies. And you see on blue on this chart is the stock appreciation, so the value of the SP 500, and on red is the earnings of the companies that are part of this SP 500. And you see that the earnings and the stock price typically should go together. So the more earnings the companies make, the more you value and more you pay for it. But you see there in 2000, something happened there where the stock price and the earnings of the companies kind of decoupled. That's a bubble. Okay, so we are paying more for the companies than what they are worth. And of course, it ended up badly. So if you remember in 2001, we had the big crisis. Then it's back to being correlated. And you see, in 2018, we got into the same place. So the earnings of the companies since 2012 or so are flat, but the SP 500 keeps going up. That's not good. And the COVID crisis makes it even worse, as you can see at the very end on the right. Oops, sorry, I moved too fast. And at the bottom, we see one specific stock that you guys are all familiar with, which is Apple. And it happened the same. So in 2018, Apple was kind of valued more or less according to the earnings. It decoupled, and it's getting worse and worse. The ratio between how much we value a company and how much earnings they make is called PE ratio, price earnings ratio. And therefore, it reflects exactly that. So the price earning ratio, historically, you can see it in this chart, is at about 14. So typically, you pay 14 times more for the stock that you buy than earnings the company makes. And that's historically the case. And you can see that lately, as we get closer to 2020, but especially after 2008, the price earning ratio went ballistic, which means that it's the same story. We are paying too much for what the companies are worth. And here on the right, a few examples with Netflix, Amazon, and Tesla. Actually, these numbers you can see surrounded in red is the PE ratio, which should be like 14 or so. And we are talking about 121 or 236 for the case of Tesla. That's actually from a week and a half ago. Today, these numbers are bigger. It's 138 for Amazon today, and it's 260 or 80 for Tesla. I don't remember. So what means, if you take Tesla, what it means is that if you buy a stock of Tesla today, it would take you 280 years to recover the money you put in, right? So if you put the money in and buy some shares, the earnings of the company give you money back. It takes 280 years to get your money back. And this obviously speaks for it. It's a bubble. I was just trying to put a little bit of specific perspective. This sentence at the bottom of the chart, it speaks for it too. It says that almost 20% of the capital of these 500 biggest companies in US, the 500 biggest, 20% of the capital, it comes from the 5 big ones, which are these guys, Amazon, Netflix, Microsoft, this type of people, Google. Well, if history is of any help, each and every time that the market had this situation where the whole market was kind of owned by the 5 big companies, each time that this happened historically, it ended up badly. So we'll see what happens, but it's not a good sign either. And how about the economy? We are talking about the stock market, but maybe the economy goes better than the stock market. Well, the answer is not really. So we start with this chart here. It's the global volume, trade volume in the world. It dropped down dramatically. I think it will recover, but there is a tendency of deglobalization of the world, which will keep dragging this number down. This is a very interesting, here on the right, upper right, a very interesting chart, which is what they call the zombie companies. A zombie company is defined by a company, you can see it on the right, a company whose earnings before tax are lower than the amount of interest they need to pay their debt. That means that with all what they make, they cannot even pay not the debt, but even the interest that they need to pay for the debt. Obviously, it's back to the family, right? So it's like you own something, but the debt you have for it, you cannot even pay the interest. That's a very bad situation. Well, the number of companies in US that are in this situation went up since 2008. Again, 2008 is a clear date. We'll see later what happened in 2008. But it went up to 20%. It's an outstanding number. 20% of US companies are zombie companies. And that, of course, is going to bring a tsunami of bankruptcies. And this chart down there talks a little bit about that. On red, we have the delinquency, people who stop paying their debts. And on blue is the unemployment. And you can see there is obviously a correlation between the two. COVID came with a huge unemployment. The bankruptcies didn't start it yet because the government is kind of holding the ball. But you can guess where is this going.
Gaspar, maybe one thing to add is in Germany. So you know, when you think about Germany, rock solid economies, the story of Wirecard. So nowadays, when companies are going bankrupt, they can go bankrupt within days. So what happened is it was a matter of, I don't know, 5 days when they discovered some discrepancies of the balance sheet of Wirecard, and in 5 days the company went total bankrupt. So and the share price from 140 euro, it dropped down now. I think they are at 2 euros, and they will be taken off from the DAX. So I think here also the challenge with this whole situation, that everything is happening way much faster than ever before.
Absolutely, absolutely. Therefore, if you invest thinking, oh, I will have time to get out when the things get nasty, maybe it's wishful thinking, right? So you need to be very careful. Anyhow, don't worry. In the next session, we'll tell you how to avoid that. And here we have another indicator, which is the GDP, right? So what happens with the GDP? Well, on the left, you have the variation of GDP quarter by quarter, and you can see that in quarter one, it dropped 5%. Quarter two is going to be announced this week, probably. But we're expecting a fall of 35%. Just put this in perspective versus the crisis of 2008, a little bit more on the left. It's huge. And there on the right, we have the GDP as it moved through the years. And one thing I want to say is that people are talking about this V-shaped recovery, right? So the virus goes down, the virus goes up, and we are back where we were before. Well, that ain't going to happen. And this graph talks about it. But what is interesting is not only a V shape is going to be more of an L shape probably, but look at the slope. So for example, in 2008, not only the market went down, but then the rate where the stock price goes up is also lower than before. So you should expect something similar in 2020. Okay, we talk about how bad it is, right? So it's not a nice perspective. So what are the governments and specifically the central banks doing about it, right? So these guys are supposed to be there trying to help the economy recover and so on. So let's take a look at what they do. So the first and main tool historically from central banks when there is a crisis have been the interest rates. So the central banks set up what is the interest that you pay for the money. And what they do, as you see here, we're going to analyze the central banks in 2008. 2008 is a very interesting moment. So you see there, before the 2008 crisis, the economy was kind of accelerating, and the central bank was feeling, oh my God, this is going to be a bubble again. So what they did is, you see down there, the upper one is the stock market, the lower one is the interest rates of the Fed in US. You can see that they raised the interest rate from 1% to 5%. And the objective is clear, is if you raise the cost of money, people are thinking twice before getting into debt, right? So if you pay more for the debt, you will be more careful. And with that, they try to disencourage the taking debt unless they have to, because they have a very good business model or whatever. But people need to think twice. Now, when the crisis came in 2008, what they do is the other way around. So in that moment, the stock price went down, there was unemployment, and we saw it before. And what they do at the moment is they go down with interest rates, and the idea is do the opposite. So as companies struggle with the economy, they are trying to incentivize or help the economy in general, introducing cheap money on the table. Okay. Now, unfortunately, this situation, this tool that the governments have been using, it kind of is stopping working right now as we speak. So, and in this chart, I put together on the bottom the same corporate debt, that the wave of debt that we saw before, and on the top you have the interest rate, and you see there that as the debt went up and the country keeps accumulating debt both in corporations and in the government, the interest rate cannot be held up anymore. And indeed, this last bump in 2018, for example, the Fed had to take it out before even COVID-19, because when they went up with a higher percentage, the economy crashed. And why did they crash? Because they are all under debt. So as you raise the interest rates, if the debt is too big in the country, you cannot hold it. So that means that we can expect to have quite an amount of time of interest rates close to zero, because the debt is so high that simply the economy cannot hold higher interest rates than something close to zero. And if we look at other than US, here above we have also the Eurozone, Japan and UK, and down there South Africa. You can see that it's not just US, we are all in the same boat. So actually, for example, the Eurozone was even worse, and it was close to zero even as early as 2014 or so. And they cannot raise the percentage anymore. So this tool of raising the interest rates is gone. It doesn't work because of too much debt. Okay, so what else are they gonna do? And here comes the change in 2008 that drives some of the things that we were saying. Hey, look at 2008, what happened there. It's being called quantitative easing, which is a nice way to say print money. That means the central banks are literally printing money out of thin air to pay and inject liquidity in the economy. The theory of this is called modern monetary theory. It looks quite good in paper, in theory. The idea is, hey, if it comes a crisis and the companies struggle and the economy is kind of going down and there are less trade and so on, why don't we inject money in the economy in different ways? And this money allows people to buy more goods or more services, or companies to start investing and bridging the problem, and that stimulates the economy. And when the economy goes back to being healthier, then you can take this liquidity away. Okay, that's the idea. Oh, it sounds good, right? Now, in reality, it's not that easy, because how do you drain the liquidity out? There are only three possible ways. The first one is that you change the key elements of spending. That means you lower the taxes, you put higher taxes and you spend less as a country. But this is very unpopular, and there is no politician that's in the mood to do that, because they will not get re-elected. If they raise taxes and they start cutting on the social services and things like that, it's a recipe for disaster. So the second way is borrowing money. So borrowing, the state will start issuing treasuries that people buy, and they use that money to inject liquidity. Well, the problem is that with the amount of debt that is out there, nobody buys the treasuries anymore. Or let's say, maybe better said, there is not enough people willing to buy treasuries at low interest rate. Remember that they cannot put a high interest rate because there is too much debt. So they sell treasuries for peanuts interest rate. So who is buying that? So not enough people. So that leads them to printing money. So what they do is the government issues treasury bonds to get money to inject in the economy or to give to people if they are unemployed or whatever it is. But nobody buys this debt, so they buy it themselves. So they just print money and they inject that money in the economy, right? It's very interesting. Now, let's take a look at how this printing money played out since 2008, which is the point where this started being massive. By the way, the idea of quantitative easing or printing money is earlier than that, but it was more done in very early times, like in the wars and things like that, or in banana republics, right? So in countries like Venezuela, places like that, they do that. When they need money, they just print money, and then they get a super inflation. But anyhow, let's take a look at what happened in 2008 in US. So as you see here, after 2008, and the top graph is the US stock market, and the lower graph, I put two things there. On black is the amount of money they print, and on orange is the interest rates. And you see in 2008, they went down with interest rates, as we said before, to make the debt more swallowable, more digestive. But they start printing money, and they print like, until then, the US had only printed like $1 trillion, which is a lot of money, but they were kind of in a very slow mode, incrementing this number. And in 2008, they moved very fast from 1 to 2.5. In 2011, the market still was crashing again and again. So they went and put some more money in. And even in 2013, they went again into a quantitative easing. And altogether, they moved from 1 trillion to $4.5 trillion. This is a huge amount. It's multiplying the number by 3, never done before. Now, the idea is sooner or later they will take it out, right? As we saw in the theory, if that's okay, then you see the stock market was actually going up. You see it in the blue line above. The stock market reacted well to all this injection of capital and liquidity and debt, and kept going up. At the point of time in 2018, the Fed decided to start taking out some of this money because the economy is going well. So they start, as you see, in 2018, the amount of print money goes down because they were taking it out. What happened? Well, it didn't work. So the market crashed. That was the crisis at the end of 2018, and they went back to printing money again. They went back to lower the interest rate again. So it looks like the economy become addicted to this liquidity, and when you try to take it out, it doesn't work. And then came COVID in 2020, which is another huge printing of money, $3 trillion with COVID now, which is in just 1 or 2 months, they print as much as in the entire cycle in 2018. So it's quite a huge reaction. And it puts them into $7 trillion And just by looking at that, it's smelling like that's not sustainable, right? So how can it be that we just keep doping the economy this way? And this is the beginning of what's wrong with it, right? So that was it. That's what the central banks are doing. Interest rate play and printing money lately, as of 2008. What's wrong with it? Well, the first one is what I just said. It looks like the economy reacts well. And here I put 1, 2, 3, 4, 5 of the biggest crises ever, right? So the Great Depression in 2029, the oil crisis in 73, the dot-com, and the financial crisis. And if you look at the time to recover from the crisis, it looks like we are getting better. Every time we recover faster. That's true. But why are we recovering fast? It's because of the debt, right? So in the previous crisis, when there was a crisis, the companies that were badly managed, they were crashing and disappearing, and their assets were maybe bought by other companies that were hopefully managing it better. And the recovery was through organic competitivity, right? So the companies that were surviving post-crisis were healthy, had no debt, and they were more competitive. But that's not what's happening now. What's happening now is if the company struggles, we just give them more debt at cheap pricing. And you can see I overlap here to the SP 500 below the debt, the government debt, and you see how interesting is that the slope of the SP 500 and the slope of the debt is coinciding, right? So it looks like we are holding the economy through debt. And here on the bottom right, I put again another sign of debt addiction, which is this zombie companies. I talked about this before, but I just want to bring it back here on as a sign of debt addiction. Any comment this one?
I was thinking about you show here the government debt. So before 2008, it was not possible that the government is buying debt of corporations. So practically they invented also new ways.
Right.
So today it's possible for the U.S. government to buy corporate bonds as well. So,
indeed.
This gives the companies liquidity, and this gives, additional time for the companies to survive, even when they are not making money.
Yeah, actually, it's illegal for the Fed to buy companies' bonds. So what they did is they created a government entity that buys it, and then the Fed funds them, right? So it's ridiculously, it's like a trick, right? So they fund the company that then this company can do that because they cannot legally. It's clearly a shortcut.
And this is too big to fail. So we keep it alive, although we know it's not the right thing to do.
Yeah. Now, what's wrong with it? Number two. So, yeah, this balance sheet on the left, which is again the printed money, we went very fast, as I said before, but don't underestimate. We are at the point where they cannot go backwards, right? So the amount of turmoil that is going to be generated right now, if they stop doing that, is too big to fail. Ishvan, you nail it. And therefore, this, for example, is the graph from Morgan Stanley, where they predicted, the last part of the course, the prediction, they predict to reach $10.3 trillion this year, and it will go on and on from there. So theoretically, when you extrapolate that, it's printing money to the infinite. There are even people who are asking, why do we pay taxes? If it's okay to print $10 trillion, why do you bother even collecting taxes? Which, of course, is ridiculous, but that's the nonsense that we are getting at. And here on the right, I just wanted to show up again that that's not just US. Here we have the Fed in US in red, the ECB, the central bank in Europe, the Bank of Japan, and the Bank of China. They all printed similar amount of trillions, and altogether they are in the range of $26 trillion, all of it from 2008, right? So this world economy moved from printed money levels of what is it, 4 or 5 trillion altogether into 26. So it's times 5 in few years, and especially now that's pre coronavirus. So it's gonna get worse. Okay, so what happens when you print money? Well, part of this money goes into the market, right? So this graph here above.
Did you lose Gaspar again?
Yeah, Isvan, I think Gaspar, I don't know if he's not off, he's still there. But we're not hearing him at the moment. I think he's frozen. His screen is frozen again.
Yes. Well, let's wait for him to get back. There were a couple of questions. Maybe we can talk about the question.
Yeah, 100%.
There was, I tried to answer the questions. There was a question about Australia. So I mean, when we looked at the economies worldwide, they are in a similar situation. So they are doing the same things, and they are copying each other. It's like a race between the economies. So I don't think Australia is any better. But what I promised to the one who asked the question, that if he leaves the email, we will get back to him with a bit more details. There was a question from Sonia about how. So if you have a business, how do you not get pulled into this turmoil of the government? So that part is back.
Okay. Good.
Let me answer one of these questions.
Okay, go ahead.
Question was that if you are a company or a business, how do you not get pulled into this mess what the governments are creating or the central banks are creating? And I said it's a difficult question, but I think common sense would be to increase cash flow and to reduce debt as much as possible. And
right.
I would say that the debt is not necessarily bad, because when the governments are trying to deleverage this situation, they will have to make the debt cheaper and cheaper. But you have to make sure that your debt is the debt level, and I think you will come to that how you calculate this investment position. For instance, that you can still pay back even if the worst comes worse. So
right. Yeah, it's back to not trying not to be one of these zombie companies, right? So your cash flow needs to be able. It's not that you shouldn't take any debt, but you cannot take debt that the interest is higher than the cash flow that you generate. It's kind of obvious, but when we look at which company you want to invest and looking forward, the debt is the first thing you look at, right? So you look, of course, on companies that have growth and this and that. But if a company today has a lot of debt, you should discount them. Anyhow, so back to this. This is the slide where you lost me, right, Tijan?
Yes.
Yeah. So I was saying, okay, well, all this printing money gets part of it into the market. And M2, which is the graph above, the graph below is the same printing money that we talk about. And the graph above is the M2, which is the amount of money that there is, right? So there is an amount of money in the market. And the graph below is a zoom on between 2008 and 2020. And you see that this area growed up. But interestingly, the printing money on 2008 first was more gradual and slow, if you wish, and smaller, but also it went mainly to bail out the banks. So it ended up, a big portion of the bailouts of the 2008 crisis were into increasing the bank reserves, and therefore the path to the market was slower. But now in 2020, it's different, and the governments are spending much more money directly into people who spend the money, like bailing out also companies, not just banks, but companies, or putting money into unemployment benefits, or even as USD, they send a check to literally everybody in US, and that goes directly into the market. It's not changing now. Okay, and that's a little bit tricky because, you know, if you ever played the Monopoly, right? So if every time you go through the starting point, they give you some money, but if all of a sudden they start giving you triple the money or even more, then you will start spending, and that will make the price go up. Now, the price doesn't go up, the price of things doesn't go up immediately when you give the money to people, but when people start going around the board of the monopoly and start buying everything they can, that's what brings the prices up. And therefore, it's tricky because the government is now trying to avoid this deflation, so they are putting money on the table in the hands of people to avoid that the economy goes down, but it doesn't immediately react, but it will react when the economy starts circulating. And when they do, then it's difficult to control. It's a little bit like the hot water of the shower, right? So when you have this cold and hot water tap, so they are opening the hot water now, and by the time they measure and it's hot enough, it's too hot, right? So that's probably what's going to happen. And now I'm going to use this chart to talk about the effects of this increase of cash, right? So first of all, I signed here in red, this is the pyramid of all the assets that we have. So on the bottom, I put gold, then we have cash, which is the one we are going to increase. Then we have debt, like in the form of bonds. Then we have here the stock market, then commodities, real estate, and finally derivative, which are also a big portion of it is debt. Now, what happens when we increase the cash? And pay attention to this, because the effect of the increase of the cash is not the same for every asset. So on one hand, we have the debt that is having a link to the cash, which is nominal. So you own money in dollars or in euros or in whatever, but it's a number in dollars, so it's nominal. So if all of a sudden we all have more cash, then with respect to the cash that we all have, the debt shrinks. So, and if we are all having double amount of cash than before, then the debt relative to the cash shrinks to the half, right? Very interesting. But these other assets like gold, stocks, or commodities, real estate, it doesn't link like that, because the link is not nominal, it's a market link, supply and demand. Therefore, if there is more cash, me having a property or an asset, I will have less tendency to sell it, because now all of a sudden there are more buyers than sellers, and therefore the price will go up. So interestingly, as you increase the cash, the debt shrinks, but the assets inflate. Now, you may say, well, I've in 2008 we had this cash coming into the market. I've not seen it because the CPI, the Consumer Price Index, it didn't go. It went up, but not that much. But I'm going to argue that this is not the case. And in order to do that, I'm going to take, for example, in this case, the stock price versus the cash. And that's the SP 500 again, right? And you see that between 2015 and 2020, there was an increase of 50%. So the stock market appreciated versus cash 50%, right? Now you can say, oh, maybe that's not devaluation. Maybe that's not that there's too much cash. Maybe it's because of the SP 500 went up because the companies are working so well, or the valuations are worth. But I'm going to counter-argue that with, if we do the same exercise, but instead of relating the stock market to cash, we relate it to gold, which is in the same category of respect to cash, of increasing the price, you will see there that the SP 500 did not grow at all compared to gold. And actually, since 2018, it's making lower highs and lower lows. So it's going down, and it went down approximately 25%. So that means the increase of the stock market, SP 500, is not real. It's the cash that is losing value, even if it's not shown in the CPI, which is designed.
And it's practically inflation, what is happening here.
Yeah,
relative to real assets like gold.
Indeed. Okay. Oops. Yeah, and so that's it, right? So that's what's going on. That's what happens, and that's what it is. Now I'm gonna this could be even seen as a kind of a summary, right? So I would call it the debt trap, right? So we talk about the Fed doing all these things. It doesn't look that they know what they are doing, right? So they are keeping the market artificially high and it's going to crash. And why do they do that? Is that the right thing to do? And so on, all these questions. And I'm not a Fed expert. I'm not sure if I would do it better, but I would argue here that at the level where we are now, with the debts that we have, they have no choice. And I'm going to drive you through this. So as we said, it starts from debt, right? So we reach these high levels of debt that we have seen on the left, both the government and the corporate, up and down. And that, we said, is driving the interest rate down. The Fed and the central banks, they cannot raise the interest anymore. If they raise it, immediately there is a collapse, companies bankrupt, and the stock market collapses. So they are tight hands, they have to keep the interest rates low. Now comes COVID here on the top of this chart. So they have to do something about it because the economy is kind of collapsing in February. But they cannot even touch the interest rate anymore. They are really at zero. So what they do? They print money. That's what we just described it. If they don't print this money, the amount of companies collapsing immediately in February would have been, the entire 20% of the zombie companies and probably even more than that. People on the street, unrest, you name it. It would have been a little bit like what happened in 1929 in the Great Depression, where people were in the street begging for food. This type of catastrophic event. Therefore, the Fed and the other central banks, they don't allow that, and they start injecting the money. The money is converted then into more liquidity that goes to the market, which initially it's okay, but it helps. Actually, people can survive the month, so to say, but it leads to the effects that we were saying, which is inflation, and it's going to be huge. Okay, now what is the end game of that? So there are only two possibilities, nothing else. There is no that's the beauty of this analysis is you know what's going to happen, because there are normally in investment there are many options of what to do. But this is driving us to only two scenarios. The first scenario is that they succeed to do that. They succeed to hold the economy kind of okay through debt. And that brings currency devaluation. Okay, this inflation that Ishan was talking about, it goes on for years, maybe a decade or maybe more. And this inflation shrinks the debt, as we discussed, while inflates the assets. And when this is ending, well, it's ending when the debt it's in small enough as a percentage of the GDP and the cash and everything else that is manageable. So right now we are in a situation where the debt is not manageable. Back to the example of a family, we cannot return even the interests. But if we start getting inflation, which the central banks are looking proactively, they want inflation. So to reduce the debt, reduce not nominally, will still be the same number in dollars, but if the dollars are worth less or less worth, then the debt is shrinking, literally, and it will go on and on until the debt is manageable. Then the economy will stand by its own foot. That's scenario one, which is a good one, even if it brings the assets down The second one is even worse, which is a financial collapse. That means they don't manage to keep that on. The market loses faith in the dollar, and companies start bankrupting like a domino, very fast, as this one said before with the example of the Wirecard in Germany. It could be that's a possibility that we have a big collapse like it happened in 1929, and there is nothing we can do about it once the domino starts. But it will end the same way. So in both cases, you end up with hard assets going up, and that's the end of the game. It could take 1 year if we crash, it could take 10 years if we don't, but the end game is the same. Now, I'm going to go back to you. What are you going to do about that? So first, let me show this graph on the left is very interesting. It shows the wealth of the people, how it evolved in the last year since 1989. And you could see there that the rich people got richer, the top 1% of the population in terms of wealth, they got into a 300% increase in these years, while the bottom, they were losing acquisition power. Why is that happening? Why the rich get richer and the poor get poorer? It's an interesting dynamic. Well, we go back to the same chart. So what happens is that the rich, they have their assets invested on real estate, on stocks, and on gold. While the bottom 50% of the population, they don't have the luxury or the drive or the education to do that, and they have their assets linked to cash. Their salaries are cash, their savings are cash, their pension plans are cash, and it goes down with all this money play that the Fed and the other central banks have no choice than to do that. And therefore, it's a course set. And therefore, that really kind of introduces where are we heading, which we will not cover today. We will cover that in the next session much deeper. But it introduces, obviously, it's about moving your wealth from cash dependent to assets that can withhold the inflation well. And that's the last slide for today. So again, as a summary, it's a big crisis, and it will not end up when the virus goes away. It will not end up because the crisis was there before. The virus was just bursting it. The central banks is doubtful that they have a good plan for us to land properly, where it will be a landing through inflation at the best. And therefore there will be unemployment, there will be inflation, and who will pay the usual subjects, which is the people who depend on salaries, on pensions. And what to do, I just explained that, get out of cash, right? Get out of cash. Some people think about cash as being something safe. You have it in the bank, nobody touches that. But in reality, with cash, you have 100% certainty that you will lose money this decade that we are starting now after COVID. And with that, that's basically the presentation. I'm not sure, Ivan, if you were reading the questions and you have one or two that you want us to answer. I was obviously not focusing on the questions.
So I tried to answer the questions, and they are interesting ones, similar to what we discussed. You know, when do you think about the debt which is good, and what is debt which is not good? So, and sorry, what I answered is if you have debt and you can pay it, and you have it in real assets, actually this can play out for you extremely well.
Yeah, but you need to think about what do you get out of the debt. For example, let me give you an example. If you buy a house and you got into debt to buy a house, and the debt to return this money, you pay more money than what you would pay as rental, then it's a bad investment. So you need to think about rate of return. So if I put this money and I get debt, and I put this money on that I need to return it, what do I get out of this debt? If I buy a house, for example, and then by buying a house, I'm saving more money than if I wouldn't buy a house, then it's okay. But if I'm gonna pay more money by buying a house than renting, I would rent it. I personally live on a rented house, and I have my money invest it because I make more money than buying a house. But it depends on where is the house located, many things. Istvan?
Yeah, I think so. It's a good cliffhanger for the second session. So in the second session, we are going to cover what to do in this situation. I think the message, Gaspar, you hammered it. Move out of cash and move into real assets, and then we will talk about what do we mean by real assets in the next session.
Yeah, and this situation of COVID actually it's so distorted that not all the assets are going to do well. So we're going to try to answer this to you guys, because some assets will do really well, and we are 100% convinced, and some others are very risky. So we're going to try to go more into what assets. But it's interesting to have here why is this happening, because there is a link between which assets we pick, linked to what you just heard today about what's happening.
But by the way, Gaspar, are you going to put up our email address and phone number?
Yep. Here's our email and phone numbers. Actually, we are giving this presentation to Corbus for distribution. So if you guys want the presentation, it's going to be available. And both email and WhatsApp phone number is there. So you guys can contact me and Istvan if you have more follow-up questions, either now or after the next session.
I'm also adding for those who want to be on the next talk. The next talk will be on the 14th of July. It's next week, Tuesday. So if you get a question, I've seen people asking questions. I think most of the questions will also be answered in the next session.
Indeed. We are going to go deeper into SP500 yes or no, and the different asset classes. Very good. Thank you all for your time.
Thank you, guys.
Gaspar, there's just a question.
Yeah.
It says the lies told to us that COVID caused the financial issues, yet it's a bubble waiting to burst. COVID just burst it for us. Is that correct?
Yeah, that's correct. So if COVID would not have come, this would have bursted anyhow. It would not have been maybe in February this year. It would have been maybe in December or early next year or something like that. But the levels of debt were unaffordable before the COVID. COVID just make it a faster crash, if you wish. But anything that would have happened, maybe tensions between China and US or the Iran making something with the oil or something like that would have bursted anyhow, as it happened in the previous crisis. The previous crisis, there was always a name like the housing or the this or the that or the oil, but it was the same. It was debt. So there is always the debt accumulating, and then something happens that pulls the domino effect. And in this time was the COVID, but the COVID is not the guilty for the debt bubble.
Okay. I think everyone, you have the details. Please send out. I think this is only the first part. So please come to the next part. I think the next part will explain a lot on how to invest. For me, it's important the replay will be up by this evening for those who want to go rewatch and see the replay. But also invite your friends to the next one. I think that is going to be informative. And get your questions ready, because if you want to make money, you need to know how to invest. All of the rich people in the world are investors. They invest their money and they manage their money. It's time for you to manage your money so that you can become even more successful and build your empire. I want to say from my side, thank you for Istvan and for making all the time in their busy schedule. It was challenging to get them on this because, these guys are so busy and making money that I feel honored to have them, their experience and, to teach us. I think we need this in our businesses and in our lives. So from my side, I want to say thank you for your time. You guys must have a beautiful day. And if there's no questions, any last words from Istvan and then Gaspar, and then we end this call.
Well, maybe one comment is this was a pessimistic outlook, if you wish, but I'm making more money now than ever, right? So it's all relative. If you know what's happening, it's always easy to make money. and now we know more what's going to happen than maybe before, and that's I'm optimistic about that. At least the portion of how to avoid being dragged down by the crisis. Ishvan?
And what I wanted to add is that if you read the news, there are so many conflicting messages, and it's so difficult to understand what's going on. So this is what we compile together, our understanding of the situation, and we are pretty sure that this is going to play out this way as Gaspar presented, and we want to help you to avoid how to say a bigger problem by putting your money there where it works and not putting your money into other places where you will just lose its value. So I think it's again an honor to be here, and it was really a challenge to get this together. But so far so good, and a very good cliffhanger for the session we are going to do next week.
Very good.
Thank you.
Cheers, everyone.
Thank you. Bye-bye. Cheers.